Great. So maybe, Lowell, if I can ask you, do you want to introduce yourself and what do you do?
Sure, thanks everybody. So my name is Lowell Campbell. I am South African and I start this everywhere I do a talk now. We are the Rugby World Cup champions and I'm going to live that for you. Exactly. I work with the IFC, the International Finance Corporation. I'm part of the global team and primarily I look after global digital bank work that we do around the world. Done a lot of work in the Philippines, South Asia and many other geographies. So yeah, I'm just happy to be here and just share some of that knowledge and see how we go.
Thank you. For those of you who don't know, I'm Antonio Sparovic from Oradian, co-founder, CEO. We do cloud-based core banking system for financial institutions. Grew up in South Africa, so Lowell's fellow South African. So when I got to the Philippines, everyone was like, "Did you meet the South African?" And so we've been friends for a while. And the objective today is something about that both of us are very passionate about, coming in from different angles. And so I kind of wanted to discuss a little bit about the role of technology in financial inclusion. And I think financial inclusion has kind of had a different or bad rap recently. Through things like microfinance, but I see a lot of interesting, positive things, particularly bringing financial services to everyone, and technology is driving that. But before we deep dive, since last year's conference, what have you seen happening, trending over the last year?
That's quite an interesting question. I mean, I think I'm doing a lot of work in Bangladesh as well, and obviously we've seen the new digital banking regulations come out in Bangladesh after quite a long period of time. So we're starting to see a number of, let's say, I wouldn't say missing, but geographies that had not yet gone into a formal digital banking sort of framework in Asia. So we've seen that primarily starting to solve itself now. So they've issued licenses there. The Philippines obviously has, Indonesia, Malaysia, etc. So we're seeing digital banking starting now in terms of the formalizing it. But more importantly, though, we're seeing a lot of banks that are looking to transform themselves more aggressively. And it's not, we've all heard transformation for however long. I mean, it's just, the list goes on. But I think what we're seeing now is in those markets where digital banks have now been approved, banks are sitting there and question themselves and saying, do we need to actually be a digital bank? Or can we actually be a digital bank if we just do things differently? So we're seeing a lot of those conversations going on. I'm working in a lot of institutions now that are doing neobanks. So they're sitting there and saying, as a universal bank, I can do everything. There's nothing that stops me from doing it, but ourselves. And that's the big gorilla in the room, is that the institution themselves, in terms of culture, in terms of current technology, in terms of all those things, are often the inhibitor, or always inhibitor, if you want to call it that, to aggressively roll out what would be a really good competitor to a digital bank. So we're seeing a lot of that from the banking perspective. But then we're also seeing, and I mean, I hate to say it, everybody says it all the time, but AI is obviously starting to do a whole bunch of things. But from my perspective, where it's a little different is I think, we've spoken about it many times, so core banking has always been at the center in financial institutions. And obviously these are my own thoughts, not from an IFC's perspective, but I see that shift. I see data becoming the core. So you almost have a data core rather than a core banking, for want of a better explanation, and then allow core banking to do what it actually does. It just captures the transaction. It captures the debits and credits, and it does the things. But your entire business gets driven by what comes through that data junction, because that is what it is. Often, in fact, I was talking about it to somebody today. A financial note is just merely a representation of an instrument or of data, if you want to call it that. Data is flowing somewhere, and it's just represented by this note. So we're starting to see a lot of that in the market as well.
If I pick up on something you said, I find interesting and observe a lot. So everyone's talking about digitization. It's been going on for a while. It accelerated through COVID. But is it all about technology, or is it about mindset? Because this is what I kind of, from my perspective, I always find is, without strong leadership, no amounts of technology or budget is going to solve any problem. And I just, I always find it interesting because everyone's like, what about, technology is going to automate everything. People are not going to get involved, will not be involved. And yet I'm thinking, it's the people that are the only enablers of making this work. How do you tackle that when you speak to your customers who come to you and say, oh, we want a digital bank?
So people who know me well, I've used this expression so many times it even bores me now, but they cloned Dolly the sheep in, I think it was 93 or 94, whenever it was. So anything is now possible. So often you get people that will sit and focus on the technology. Oh, I need this, I need that, I need that. And then you give them all of that, and things still go pear-shaped. So you're 100% right. It's not about the technology. It's about the people deciding what it is that they want, how they're using the data and the segmentation in the market to drive a particular result for whatever their client need is, and then going to the technology partners and saying, this is what my market wants, this is what the customer wants, this is what the product actually needs to look like to make money or to do something in the market, and then let's put the technology on top of that. So I think the saddest part is I think everybody's happy to Google. And we're never satisfied with what we have. We always think we need the next, without bedding down what we have. And without bedding down what you have, you are absolutely never going to get to where you need to be. And that, going back to a little bit of morphing into the original question you asked, is what I'm also seeing with a lot of clients that I work with is we have to go back to the foundational elements. Got to go back to, do you have a transformation office or a chief transformation officer? Do you have a data environment? Do you have a technology environment? Do you even have a transformation environment around people and culture and things like that? So we're going back to the basics.
And again, it's about the people.
It's about the people every single time, and that's the most important.
So if we bring this back to technology and digitization, sorry, thank you. What do you think are the important metrics that one should put in place to be able to help to go through this transition and then to measure, like you said, you can buy the technology, but what are you doing with it? What are the key things to be observing and measuring that you're doing right? Or what's the best North Star to help?
Ultimately, at the end of the day, that's quite a complicated question, but I think at the end of the day, if you have a happy customer, you're actually golden. So if your customers are consuming you on a continual basis. So normally what I do is I have sort of a rule of thumb, back of the cigarette box. I don't smoke. But any customer generally will do 4 transactions in a month. They'll do a cash in or whatever that looks like. They'll probably withdraw something and they'll probably pay 1 or 2 things. So if you have all of these things that you've now put in place, but you're having 0 customers, or you have customers, but you have them doing 0 transactions, that shows you that something is not right. It doesn't necessarily have to be the tech, but it could be the tech. I mean, the tech could just be so complicated and so irrelevant that nobody wants to use it. So it's a combination of both. So for me, the ultimate goal is how cheaply can you provide a service to your customer? How elegant and how relevant is the actual service that you're providing? Those two as a combination, there are a couple of others, but those two are generally quite good. And if you allow me for a moment to put the inclusion hat on, from an IC's and World Bank's perspective, there's multiple billions of people who don't have access. Now, is that a case, and this becomes the great question, is it because they don't want to have access, or is it because the access is not given to them? That's a very big question. But often what happens in financial services, we're too expensive to get to the person who's on the 7th island in the Philippines that only makes 2 pesos a day, and we say, they're not transactable. But actually they are. If you relook at everything you do and you relook at your cost to serve, which now to bring the technology piece, technology enables you to do that. If you go back to the data piece, you understand what you're providing, what they do, how they want to consume it, and you're using the technology to solve the problem. It comes to people.
And I think that's really important because I was going to push on this financial inclusion aspect now, but one of the things what I've observed is people see technology as a way they think that technology should be cheap. And then I always think it starts on the wrong way. But effectively, your cost to income ratio is the thing that you need to be watching. And you're investing in technology to apply that. And if you apply that and you digitize it, you can have more reach. And this is a really interesting case where you say you start going across from islands and so forth. Tell us a little bit more about, from your perspective, you've done digital banked recently in the Philippines, and you've seen it in a couple of other places. What is the impact that you measure, or can you even measure it? But are you seeing an impact that more people are really getting access to basic formal services?
So I don't think people have never had access. If you go to the last island in the Philippines, and I was just say number 7,000, assuming they're in a row, but they're not. There's always somebody who's using Facebook. There's always somebody who's using Gcash. There's always somebody who's using something. So they actually have it. But what we're not doing very well as financial institutions is giving the thing that they need in the way that it will also satisfy us. So there's a win-win on both sides. So we're often saying to ourselves that, no, they're not our target market. So we're self-segmenting ourselves, and we're stopping ourselves from doing anything. Whereas, where the customer side, there is a demand. But I think the challenge that we have these days is customers now no longer need financial institutions. And I say that with tongue-in-cheek as well, is that obviously everybody would like to have a loan, and everybody wants working capital, and everyone wants to grow themselves. But what COVID showed us is they're not prepared to pay for our inefficiencies anymore. And I'm talking from a banking perspective. They're saying, if I can measure the cost to me and the savings to me, I'm prepared to use what you have. But don't come and tell me that to get what you have, I need to pay 70% or I need to pay $700. That's just weird. Because customers have had this experience. And I think we're naive to think that they don't have access to certain things. We're naive to think that they're not prepared to pay. They're prepared to pay. The most expensive thing to be in the world is poor, because every single thing is exorbitantly expensive for you. And we layer things on. So to get back to your technology piece, if we can recognize that everybody has something which represents technology, it might be Facebook, it might be whatever, how can we go to that customer and say, you're already doing some stuff. If we give you something that looks a little bit different, but relevant to you, and using great technology that's safe, secure, and relevant to you, we can make it cheaper for you, so we can enable your life, we can enable you to grow, we can do all of the things we want you to do to every single person, from the person who earns $1 to the person who earns $50 million. That's where I think we need to go.
So what I hear you saying is, it's not necessarily about the technology for technology's sake, but it's about the value that we create. And people aren't necessarily excluded as much as they're not getting the value what they need.
Absolutely, 100%.
It reminds me of a case down in Vanuatu when they were talking about teachers receiving their salaries, but the branches were on the bigger island and they were on the smaller island. So the only way they can go get their money is on Saturday, catch a ride out on the boats, go and collect the money. And if it didn't come in on time, they wasted the whole day, because it's ferry in the morning, ferry in the out. So we introduced SMS to tell them when the transaction's completed. And so if it wasn't fallen in, they wouldn't travel. And so the cost of the SMS was minuscule to all of the other costs that occur to manage their account. So it's about adding the right value for the right purpose. Technology is being democratized. The same way people are really worried about data and ownership and how do I go about this. How do you advise your customers when it comes to in-house versus outsource? And then I'll layer that question is, well, what happens when competitors start using the same outsourced solutions? And how to think about that?
Sure. So there are merits to both. So there are merits to outsourcing. If somebody can do it better for you at the same or better price, and it solves a customer need, and you can still be seen to be the champion in the customer's eyes, it makes no sense to try and do something else. But if it's something which you can absolutely do yourself, it's not going to kill your business. It's not going to take you away from your core business. So it's not like Coca-Cola is now going to start manufacturing Coke cans from scratch. Maybe they do, I don't know. But they're recognizing somebody does that quite well. We don't have to do that. So let's get somebody to do that. But nobody can make the Coke paste, or nobody can make the Coca-Cola. We have to do that. So I think it comes down to recognizing where your value is, what you can do, what you can't do, and ensuring that it doesn't impact the customer. Because often what happens is we try and layer down technology. We're trying to build things in-house because our ego kicks in. I've got to own everything. I've got to own everything. And invariably, it ends up being a terrible customer experience. We spend so much money trying to keep the system up, working the system, And it goes back to what we didn't want in the beginning. We didn't want to layer on cost. And now suddenly you find yourself in a higher cost environment, and somebody comes along, they find a great person who does it, they got it at a fraction of the cost, they deploy the cost, and suddenly your competitor has killed you. So often we get locked into what it is that we think is a good idea. We need to get that balance. So certain core banking elements, absolutely, they can be outsourced easily. You can build them yourself, but why? I mean, but why? So go for it. Look at what it is that you want to do, and recognize who's better at it than you. Because at the end of the day, it's about the customer. All you want to do is you want to know. When I was in Kenya many years ago, I was building a business, and somebody always used to say to me, "But I own the customer." I'm sorry, I'm a bit of a rebel, but you'd never ever own me. You own me for the 5 seconds that I'm looking at whatever it is that I'm using. I don't care how you got that transaction to happen. I just want to know that 5 seconds, you had me, I'm gone. Thanks for coming. The rest is your problem. But often we try and go further and go further, and the customer doesn't care. So if that is the hypothesis at the end of the day, then look at it from that perspective and say, okay, cool. What does the customer need? Who provides it better than me? What makes sense for me to do internally, and get that balance. But that doesn't always happen because ego comes in, people, which we spoke about earlier, comes in. So we need to find that balance.
So I'm going to go a long way around this, but if we go back to financial inclusion, there's often this, I think it's a misconception that it has to be about banking for poor, so it has to be cheap, it has to be, whereas what I hear a lot of things is it's about being aware of costs, about being aware of value. Profitability is a really important part of this. Can you build a profitable business by focusing on financial inclusion then? Or is this a charity space, or is there a sound business model to actually focus on financial inclusion?
Okay, so this is a Lowell opinion here. So I believe that you need to make a profit to serve the market, because the challenge is if you as an institution are not incentivized to provide the efficiencies, to provide all the things that you need to provide something to the customer, how are you actually going to do it for the customer at the end of the day? Because you're going to layer on cost. It's going to be more expensive. It's not going to work. So what is the basics of a business? A business wants to keep costs as low as possible, hopefully provide the best service to make some money for their customers. That's what they want to do. So we need to look at that, and we need to say to ourselves that if that's what businesses want to do, let's live into that. And let's make sure that they then go and do the best that they can, because the customers ultimately will sell. I mean, you will find, and I think that's this is where the challenge comes in globally at the moment, is that I believe, yes, you need to make a profit, okay? Not exorbitant profits. Let's have everything within moderation.
Not greed, you mean?
Not greed, yeah, absolutely. Let's not call it greed. But I think where there needs to be assistance, to be honest, is we need to get institutions to either be incentivized or see a way that they should actually tackle a market. So, for example, you have a big institution, I won't mention any by name, they will, as I said, they will self-segment, and they'll say, somebody who's earning $5 a month or $5 a day, just not interested for me. It's just because I can't. And I get it, they can't do it. But then that market's not for you. Go to somebody who has a willingness, who has an appetite, who has the ability, the technology, and the people to drive costs to the lowest common denominator, and then say, you know what, that guy who's earning $1, I can bank him profitably. Because if your unit economics are right, everything becomes possible. We often make the mistake, is we say a person who earns $1 a day or $1 a month or whatever it is, they're not doing anything. Okay? Some they are, so please take this all with in the spirit that it's meant. But they're all either, and I'll use the Philippines as an example, they are eating, they are buying rice, they are buying vegetables, they're doing something. The fact that we can't understand what it is that we're doing, what they're doing, and then tailor on a transaction type that is relevant to them at a price point that is relevant to them, where we can still make money, who's that on? Is that on them or is it on us? And I think that's the question we have to ask ourselves. It's not on those clients. They will always be doing something. They live.
It's a very interesting observation. And again, if we look at the Philippines, as you mentioned, they're one of the highest consumers of digital content in places like Facebook and so forth. So they have an access to it. I hear this often as well, the segmentation. But what I found is with with fintechs coming in, for example, they're also changing the game. They're looking at that very basic value of service. They're looking at the unit metrics. They're focusing on, as a business. So although they're a fintech, they're spending a lot of the time, or they're spending a lot of time on the financial business and less on the tech. They're owning the interface between the client. And that's enabling them to scale cost effectively. Because, again, I've seen this both in Nigeria and the Philippines. A lot of the banks are recycling the same 10 million customers. Mm-hmm. And that's primarily in the urban areas. But when you step out, they can't afford to service those customers. But these new clients who are just accessible directly in the middle of their homes, they're actually starting to take market share of customers who weren't really marketable before. Do you, when I reflect, we had rural banks in the 60s, started in the Philippines, microfinance picked up in the 70s. But I kind of feel very confident that with this drive of fintech and after COVID, we really have a chance of actually having formal financial services to all. Is that a fair statement, or is that a fair view?
It is a fair statement, but scaling does not lead to profitability. So we just got to be very, very careful there. I mean, it can if you've got your basics right. If you have your unit economics right, and you scale responsibly, yes, let's scale. I think what we often forget is that when the large super platforms started, the world was a different place. There was not that much competition for what they're doing at that time. Now you have a situation where everybody is disintermediating them and everybody is trying to do better than them. So you don't have the opportunity anymore in terms of time and cost to build this nice super platform. Let's say 50 million people will come, will make profits in 8 years' time. Maybe you do. I mean, maybe they've got different shareholders than I know. But shareholders come in and say, no, we want profitability in 13 months. We want this, we want that, we want that. So your opportunities to scale quickly have changed. So you've got to be very careful, is that, if you can transact one person, I can transact you because you earn $1, and I can transact you at 20 cents. It's okay, because I then aggregate you across multiple hundreds of thousands of people, and I'm still okay. But if I'm transacting you at 120, and it's costing me 100, whatever, I'm dead for the rest of time. However quickly I scale, I'm just layering on in certain segments. Often people will say, well, I'll lend to them at some point. But it doesn't necessarily mean that if I can just make you transact at a certain point, I can profitably lend to you, or I can actually do it in a way that makes sense. So there's a whole bunch of elements that come into it. But I think we just got to be very, very careful. Can technology enable scale? Yes. Can technology enable scale at efficient cost? Yes. But your business model around that, the segment you're going after, and how you understand the customer, that's where the challenge comes in.
That's key. I'll just open up to the floor. Any questions this far? Regina. Well, what's the question? Just opening up. Anyone want to kind of throw in? Okay. Well, I'll come back if everyone wants. But so, Lowell, what I hear you saying is that, one, it's a lot about getting down to the core. So thinking about data at the core. Thinking about transformation, really important. It's very much about the people, both internally and the customer. Starting profitability has to be, again, at the core. These are all very basic principles. How are you seeing some of these traditional businesses taking this on? Because I'm sure it feels like a bit of a black box or a magic wand. Are you able to kind of get that message to them? And are they able to actually pick up and transform quick enough before, let's say, the bigger players with deep pockets are kind of, they'll move slowly, but they'll eventually also transform. Everyone's going to kind of think about it.
So I don't think anybody's transformed. I just think if you're a large organization, your ability to transform it's really, really hard. Because you have your normal business. So there's two pieces. You have change the bank, run the bank. The run the bank space just goes. It goes. To change that becomes very, very complicated. And the change the bank people are often looked at differently to the run the bank people. It's almost like, why you want to break something that's already working? So you have that mindset. Then you have the other aspect, and to answer your question more directly, and why some of the neobanks are coming up, in competition to the traditional digital banks, if you want to call it that. Because what they've said is all banks recognize, or all institutions recognize the need for transformation. So it's not about people not recognizing it. It's there. But your ability to do it, that's where the complication comes in. So what we're seeing in some of the more progressive institutions is they saying to themselves, how do I now build a neobank, a bank within a bank? How do I have the discipline? How do I have the funding, because it's really important, to sort of ring fence this little opportunity? It still lives within the banks. It's still within the same regulatory framework. But what you're then doing for shareholders, for management, for staff and customers, you're showing them what a fully transformed organization looks like. So you're saying, I acquire you, I transact you, I digitize a full loan to you, I collect the loan, disperse the loan, I collect the loan, and we go on. So what then happens at the moment is that everybody has the opportunity to see what full transformation looks like. Because often people don't get to see the end result, and that's why things go pear-shaped. Because what ends up happening is that remember, we're all competing for customers, obviously, inside an institution, but you're also competing for scarce financial resources. So if it doesn't look like it's working so well today, the board will say, let's just divert funds somewhere else. So that's what we've got to do.
So where do you think, financial inclusion, who's going to actually solve that, who's going to solve the problem of exclusion? Who's going to do that? Is it going to be the new institutions, or is it going to be the big banks over a long extended period of time? If transformation is so difficult, do traditional businesses even have a chance to compete in that space? Who do you think is going to end up solving the underserved population?
I actually don't know, to be honest. I don't think there's a defined answer to that. I think those banks or financial institutions that are able, in terms of from the people, we were talking about people and culture earlier, if they're able to unlock themselves and sort of do whatever they need to get low, they will certainly achieve more success. I mean, we'll probably see some sort of institutions that do it well. Banks will buy down into them, so they'll buy that sort of market share. So, but that's normal dynamics. I mean, the people will purchase from what they do. I think a lot of the fintechs will try and do it. I think a lot of them will make a mistake because they just don't understand it well enough. But I think ultimately, at the end of the day, it's the customers themselves that are going to drive it. They're going to they're going to talk with their feet in their hands when they're busy doing, on the transactions. They're going to say to themselves, "This is what we want. This, as you were saying, in terms of the opportunity cost. This is what we want. This is how we want it. This is what we're willing to pay for it. Who of you are able to do that?" So I think we're still in that strange place at the moment where there's no defined winner. I think it's a contribution from everybody. But ultimately, at the end of the day, if you can't give me what I want, where I want it, for the price that I want it, I'm not going to use it. I'm going to find some other way of doing it.
As you said that, I was thinking about there's a lot of excitement going on in Kenya. And a lot of the fintechs started then getting very aggressive, very profitable, and so forth. And recently, their tails have been shortened by the regulator. Does the regulator play an important part of this? Kind of, how do you get that reach out quickly while you're making profitability, while protecting the end client, the end consumer? So what's the regulator's part in ensuring that there is profitability to make this business viable while protecting the consumer?
I think the regulator is absolutely critical. I have nothing negative to say in terms of regulation, because that's what protects the end consumer. Because remember, as we were saying earlier, the most expensive thing to be in the world is poor, because everybody wants to do something to you. So you need somebody who's actually going to help you out and get that done. Regulation, for me, is key. But I think where the change is coming in the Philippines is really, really good at that. I mean, if you look at the regulator in the Philippines, incredibly forward-thinking, incredibly happy to innovate and do things. So if you've got a really, really...
And make mistakes.
And make mistakes,
yeah.
Absolutely.
Yeah.
And they should make mistakes because, business moves so fast. It's impossible for a regulator to keep up. So the more they learn, the more they actually adapt. So the more you get these forward-thinking regulators that are prepared to do exactly that, I think you'll start to get that nice balance. Because in many geographies, it's like just go wild. Customers get hammered left, right, and center. The regulator has to step in. Customer confidence has taken a huge knock, and you almost feel like you're starting from scratch. I mean, look in India, for example. They regulate first. Fit in people. This is how you want to do it, which is not a bad thing. Yeah. And interesting enough, people do. So it's just a mindset.
And there's also nothing wrong with monopolies. This is an interesting one for me, is that Kenya demonstrated by having mobile M-Pesa, but it was enable monopoly, let everyone change the habit, use it, and then bring in competition. Cool. So we've just gone over. So, we have a question before we wrap up.
Sure.
A couple of questions. You mentioned a few players, you mentioned markets, Bangladesh. What are maybe the top 3 examples of either incumbents that are tech-enabled or disruptors that are pushing the agenda for next year? There's top of mind. And then second question is, how does the IFC is drive, what is the strategy of the IFC? Something has changed, has anything changed for you? Leadership, what is the focus? For full disclosure, I'm from big investments. We manage capital for the IFC. Areas that have been kind of translated in the role, not only helping regulators, but growing the role as well as investors.
I think the second one's the harder one to answer, but I'll answer it anyway because I've got to be very careful how I answer that question. I think from the IFC's perspective, we recognize the role of tech and the role of sort of these alternative environments in inclusion. Obviously newer players that are coming into the market, they're trying to drive costs down, which ultimately will extend the reach, which is the customer that we're looking to serve. So, we continue to drive that agenda. We think it's really, really important. Digital finance is a really important one for us, as is access. And we believe digital finance and access are really good in terms of a combination together. So we continue to drive that agenda, and I don't think that will change. But we also have to be responsible in the way that we do it. So, you as a traditional lender, investor, maybe you would want to go into, all sorts of investment types, riskier ones, not riskier. We don't have that luxury. Not necessarily, it's not the financial piece. It's just, in the eyes of the customer and in the eyes of the market that we're trying to serve, we recognize that failures or market failures or tech or institutional failures have a deep impact. So we want to be more responsible in how we do it. So we do look after, we do look for institutions that have that same goal and that same idea. I think in terms of markets, RCBC, for example, in the Philippines, is doing a really good thing with their discotheque. They're trying to sort of get out to a bank, trying to get out into the market to do things. So I think they're doing a really nice job. Obviously, you have the GCashes in the Philippines as well, which is and the Mayas and the Pay Mayas of the world that are doing well. Bcash in Bangladesh certainly trying and have done a really, really good job. In Kenya, on that side, you have Equity Bank as an example, which is really, really doing well. So there are a number of institutions across multiple markets. You have the payments banks in India who are trying a different approach as well, the Finos of the world, doing really, really well. You can imagine when payments banks started in India, everyone was questioning, but why do this? There's mobile money, there's a whole bunch of things. Why would you regulate that? Why would you constrain them so much? They did. Fino applied for a license, and they're doing really, really well. So it just got people to think slightly differently. So in India, I think the payments banks are doing well. A number of the large banks are obviously doing well. You have your small institutions that are doing well. So I think there's smidgens everywhere as to who's doing well. If you come to Singapore, for example, DBS is certainly trying to change the whole transformation landscape for everybody around the world. So I think the answer to your question is finding names is the easy part. I think it's how relevant have they been to those institutions firstly. Have they been successful themselves internally? And that gets measured in your balance sheet, income statement, balance sheet. That's where that gets measured. But from a customer's perspective, how quickly are you growing? How happy are customers to leave smaller amounts with you? I think that's probably the more relevant way to look at it. Because everybody's trying. Absolutely. Indonesia is doing some fantastic work as well.
So it's not game over anytime soon. There's no
far
winner.
from it.
There's far from it.
Far from it.
So in summary, what I hear, if I summarize the conversation, it's very much about sticking to the for financial inclusion. You got to focus on profitability, not greed, but profitability for sustainability purposes. Mm-hmm. You got to be very clear on what the customer value is and focus on the customer. Focus on what you do well, not necessarily having to do everything in-house. Being clear what your role is and what you can outsource. And the market's still very much open. There's no clear winner, and there's still lots to be played for.
The market is absolutely open. There's a lot of things, and as we spoke about earlier, we want institutions to succeed because that's what will drive inclusion. But where we need to see a lot more is on the open banking side. We need to get people and institutions to start sharing data. The challenge you have in a lot of markets is if I share data, you're going to steal my customer. No, it doesn't necessarily work that way. If you're doing a really good job for me, you're going to stay with me, or I'm going to stay with you. So I think ego has become a really, really big issue, but we need to see open banking, responsible open banking, take on more of a form, because that's what's going to unlock that $1 individual that I was speaking about in terms of how do we transact them, or how do we give them something relevant in a profitable way, but not greed, absolutely. So we certainly need that. But there's strong work in that direction. As IFC, we mentioned earlier, we're doing something on open banking in the Philippines already. In other markets, we're doing it. So these come back all to the agenda around access, around unlocking responsible data. And I think that's the key element, is because we don't want to start using data irresponsibly. And I think there's a lot of that going on at the moment. People talking about AI. Nobody's protecting AI. There needs to be, one needs to go with the other. I'm happy to do all these things, but governance. Who is looking after me at the end of the day?
So I'm going to share opinion there as well. I agree. Open banking is really, really critical because it increases the pie, so to speak. But the other misconception is, someone's going to steal something. What you said earlier on is absolutely right. You don't own the customer. There's nothing to steal. They will choose who they're going to work with, and so that's really important. But they get better services, everyone gets better protection, governance can be managed much better when systems are communicating. So open banking, I think we've seen the success in Europe, but I think there's a lot more to be spoken about for the future of financial inclusion, is more openness.
Financial inclusion is all about data. It's all about data, understanding what people do, finding a way to transact them. That's the bottom line at the end of the day. Because if I don't know what you do, I'm going to make my own I'm going to have my own bias towards it. I'm going to do a whole bunch of things. So let's understand what you do, and let's figure out how to do it with the technology and things. But let's start that side first, rather than zap all these technologies down and nobody uses it, because nobody wins in that situation.
I laugh because we've seen that so much, as everyone's after the next hype and what's the next headline, and they want to implement, but follow through, change management is really the most important part. Great. Well, thank you very much. Thanks for forcing you to catch a flight.
Thank you. You're going to owe me one.
Thank you. Thank you very much. Thank you.
Go further. Think bigger with Oradian. To find out more about the future of extensible banking, get in touch with our team today.